Welcome back to the deep dive. Today we're jumping into the world of corporate earnings, going to try and cut through some of that jargon. Specifically, we're looking at Conagra Brands, the company behind a lot of stuff you probably have in your kitchen right now. Okay, let's unpack this. Financial reports, yeah, they can feel like just a blizzard of numbers sometimes, can't they? But what we want to do today is really slice through that and pull out the important bits, the key insights from their latest earnings report and an outlook analysis we looked at. So it's not just about what happened last quarter. We want to explore what these numbers might be signaling for what's next and, how it could potentially impact you if you follow the markets. All right, so diving right in, what immediately jumps out from Conagra's latest quarterly report? Well, it looks like they've missed the mark on a couple of key things, actually. They reported earnings of 56 cents per share. Now, EPS, earnings per share, that's basically a measure of profit per share of stock. And that $1.56 figure, it fell short of the Zacks consensus estimate. That's what Wall Street analysts were generally predicting, right?
They expected $1.59.
Exactly. Missing that consensus is usually a big deal for the market.
And it wasn't just below expectations. It was also lower than the $1.61 they reported a year ago.
Yeah.
So, yeah, that's a drop. It works out to a negative 5.08% earnings surprise.
A surprise nobody really wants.
Right. And this isn't the first time either, is it? Just last quarter, they reported 51 cents when 52 cents was expected. Another miss, though smaller, minus 1.92%. Then you look at revenue, they brought in $2.78 billion. Again, miss a consensus, this time by about 2.18%. And that's also down from $2.91 billion a year ago.
Yeah, and what's really interesting, maybe concerning here, is this pattern. It's becoming consistent. Conagra has actually only beaten the consensus EPS estimate once in the last 4 quarters. And the same for revenue, only beat it once.
Wow, only once each in a year.
Exactly. So this isn't just, a bad quarter. It really suggests there might be some deeper issues going on. When a company keeps falling short like this, you start to wonder, well, what's really happening? Are costs rising faster than they can raise prices? Or maybe their brands aren't quite connecting like they used to? Are they keeping up with innovation? These are the questions investors start asking.
Okay, so with this string of misses,
Oh, yeah.
what's the impact, Ben? What does it mean for the stock itself and for, folks watching it? How's the market taking this news?
Well, the market has definitely noticed. Conagra brand shares, they've lost about 26.6% just since the start of this year.
Ouch. 26.6% down.
Yeah.
How does that stack up against the overall market?
It stacks up pretty poorly, actually. If you compare it to the S&P 500, the big index tracking 500 large U.S. companies, the S&P is actually up about 6.5% over that same time.
Wow, that's a huge difference. So Conagra's going one way, the broader market's going the other.
It really highlights the underperformance, yeah. And it raises that big question, what happens now? Where does the stock go from here? A lot of that, especially right after a report, depends on what the company's management says. Their commentary on the earnings call their outlook, their plans to fix things, that carries a lot of weight.
Right, what they say matters. But beyond the talk, is there something more concrete, maybe a forward-looking signal investors can track?
Absolutely. One of the most, I'd say, reliable indicators tends to be the earnings outlook itself, and specifically how analysts are revising their future estimates. There's a good amount of empirical research showing a pretty strong link between how those estimates are trending up or down and how the stock is likely to perform in the near term.
Okay, so if analysts start cutting their forecasts.
Exactly. If they start revising estimates downwards, that often signals weaker stock performance ahead. And the opposite is true, too. Investors can track this themselves, or they can use tools. Like the Zacks rank is one system that's built specifically around tracking these estimate revisions and their predictive power.
Okay, interesting. And speaking of the Zacks rank, what was it telling us about Conagra before this latest report even came out?
Well, that's telling too. Even before this report, the trend in estimate revisions for Conagra was already looking unfavorable.
And that translates to?
It translates into a Zacks rank #5 right now. That's a strong sell rating.
Yeah.
Essentially, based on those negative estimate revisions, the system predicts the stock is likely to underperform the market in the near term.
A strong sell.
Okay.
And what are the current expectations looking forward now?
The consensus right now for the next quarter is looking for about $0.50 in earnings per share on roughly $2.72 billion in revenue. And for the full current fiscal year, the expectation is around $2.19 in EPS on $11.64 billion in revenue.
Got it. Now, this is always a key question, isn't it?
Yeah.
How much of this is just Conagra? And how much is maybe reflecting what's happening in the wider food industry? Conagra brand sits in the Zacks Food miscellaneous industry category. What does that tell us?
Yeah, zooming out is crucial here. And this is where it gets Pretty significant. That food miscellaneous industry group, it's currently ranked in the bottom 27% of all the 250 plus industries that Zacks tracks.
Bottom 27%, so pretty low down the list.
Very low. So Conagra isn't just facing its own issues, it's operating in a really challenging industry environment right now. Being in that bottom quartile often points to broader problems. Maybe intense price competition, maybe big shifts in what consumers want, maybe the whole sector is just slow to adapt compared to others. And our research consistently shows that the industries ranked in the top half tend to outperform those in the bottom half by a pretty wide margin, often more than 2 to 1.
Wow, more than double the performance. So the industry you're in really matters.
It absolutely does. It's like swimming against a strong current. Even a good swimmer finds it tough.
That's a great analogy. So, okay, to get a bit more perspective, let's look at a competitor, a peer in the same industry. How about Mondelez? Ticker MDLZ. They make Oreos, Cadbury, Trident gum, lots of big names. They haven't reported their Q2 results yet, have they?
No, not yet. So it'll be interesting to see how they compare when they do.
Okay, so what are the expectations for Mondelez? Well, for their upcoming Q2, they're expected to post earnings of about $0.67 per share. Now, interestingly, that would actually be a decrease year over year, down about 22.1%.
So a drop in earnings expected there, too.
Yes. And their consensus EPS estimate has also been revised down slightly, about 0.2% lower over the last 30 days. So similar downward pressure on earnings estimates. But their Q2 revenues are actually projected to be up 6.1% compared to last year, hitting around $8.85 billion.
Okay, so that's quite different from Conagra's picture. Yeah, so what that suggests is, well, both companies seem to be feeling some heat on the profit side, judging by those earnings estimate trends. Industry headwinds, maybe. But Mondelez is still expected to grow its top line, its revenue, by over 6%. That points towards perhaps stronger brands, maybe better pricing power, or a product mix that's resonating more right now. It shows that even within a tough industry current, like we talked about, company-specific strengths, brand power, how they operate, still make a big difference. Not everyone gets hit the same way.
That makes a lot of sense. So wrapping things up, what does this all mean for you, maybe listening in, just trying to understand how these markets work, how to read the financial news? Well, we've dug into Conagra's recent performance and seen it's not just about one bad quarter, but a kind of consistent pattern of underperformance that tells a bigger story.
And we saw how powerful those earnings estimate revisions can be as a forward-looking tool, potentially more telling than just the past results.
Yeah, definitely. And also how much those broader industry trends matter, that whole swimming against the current idea.
Exactly. The industry context is huge.
So here's maybe a final thought to chew on. How much of a company's success or struggle really comes down to just its own operations and decisions? And how much is it just being carried along or pushed back by the tide of its industry or even just, overall investor feeling at the moment?
Yeah.
What signals will you look for next time you see an earnings headline? Will you look beyond just that main number? Something to think about. Keep digging, keep learning, and keep asking those deep questions. Until next time, continue your own deep dives into whatever topics grab your interest.